When you have these balanced price ranges of back and forth price action like that, remember, it takes a lot to rip right through that unless it's extremely heavy and it's being powered through with a lot of other factors behind it. But we might not get that this week. So it's important to know where you want to take your partials, which would be below this low here, consequent encroachment here, and it could come back up, trade to this one here, or just a little bit below it, not take these lows out, come right back up and trade into the consequent encroachment of this, trade right back to that, and then at a later time take out the sell side. That's what makes trading with a high resistance liquidity run, which is trading through these types of consolidations. You have to be able to pick where it's reasonable for you to take partials. So the trades that I take partials on are the ones that I'm trading inside of a high resistance liquidity run. If I'm trading on a low resistance liquidity run signature, I'm not taking any partials. They're full pulls. That means whatever I get in at, I'm picking my target and I'm just letting it go. High resistance liquidity runs are still likely to pan out and my targets could still be met, but I don't know for certain if it's going to happen during a session I'm willing to sit in front of the charts. So I have to pick out where my partials are, where I know I have a time. Knowing the likelihood of the market presenting a reluctance to get through a balanced price range. What makes this a balanced price range, by the way? The price is offered sell side, buy side, sell side, buy side, and it left the range, all this consolidation. So it takes a more meaningful move to get through all that, and it generally doesn't happen in one single pass. So what I like to do is I like to break that range up into where it's reasonable and where it's logical for the market to at least trade to the midpoint of that wick. That could be the first target to take a partial if you're bearish. The low of that candle, the consequent encroachment of this wick, and it need not take the lows out here to still be profitable. And then down here, I expect it to try to do some kind of fake thing where it trades to this level, doesn't quite get down there yet, and maybe come back up to consequent encroachment of this wick or the low of it, and then move lower. Doesn't have to do that, but I make allowance for that when I'm trading against high resistance liquidity runs. But low resistance liquidity runs, I don't have any partials in. I will stake my entire trade on the initial entry and my stop. I'll just manage it to where I can take the risk away, and then once it's removed, I just let it go because my conviction behind the analysis and the trade is that it's more probable that it's going to go where I think it's going to go and not need for me to scale off anything because it might have a retracement that's deeper than I'm willing to accept.